To maintain a clean margin profile ahead of the S1 filing, executive bonuses will be recalibrated. One position will be excluded from this cycle. The boardroom didn't react. Not a shifted chair, not a raised pen, just those two sentences sitting in the air like something sharpened for a purpose. It was 3:47 in the afternoon. I remember the exact time because the digital display on the wall behind the CFO was one of those thin red panels that never lets you forget what minute you're in. I was staring straight at it when she said it, and I didn't blink. The board has reviewed the compensation structure in light of investor expectations, she continued, her voice measured, almost gentle, the way people speak when they've already made peace with the decision. We want the pre-IPO financials to reflect operational discipline. That means one recalibration this quarter. She didn't say my name. She didn't need to. Around that mahogany table, every folder had a printed summary with a bonus figure. Except mine. Mine had a dash, a single horizontal line where a number was supposed to live. My name is Daniel Reeves. I'm 49 years old, and at that moment I was the vice president of infrastructure at a mid-cap technology company preparing for its initial public offering. 22 years at the same firm. 2 decades of building the platform the CFO was about to sell to Wall Street. And somehow, in the final quarter before we walked into the New York Stock Exchange, I was the only person in that room whose contribution had been reduced to a dash on a spreadsheet. To my right, the chief revenue officer folded his hands and studied his own packet with the focus of a man trying to look busy. Across from me, the newly hired chief strategy officer, Michael Hartwell, kept his eyes on the CFO. Late 40s, Harvard MBA, 4 months into the role. He had already been given equity acceleration in his hearing package. His number, I would later learn, had 2 extra digits. He didn't glance at me. Not once during that meeting, not once as we filed out. The CEO cleared his throat at the end of the table and offered a small, controlled smile. We appreciate everyone's commitment during this critical window. We're building something that will define the next chapter for all of us. All of us. That was the phrase that stayed with me longer than I expected, because if I was in the all of us, then why was there a dash on my page? The CFO closed her folder. Distributions will be finalized before the roadshow begins next Monday. Please direct any questions to HR. No one raised a hand. No one asked why one number on one packet had been left blank. In rooms like that, silence isn't neutrality, it's confirmation. Everyone already knew. Everyone had been briefed, except me. I stayed seated for a moment after the others stood, not because I was frozen, because I wanted to make sure I understood the shape of what had just happened. I folded the packet in half, slid it under my arm, and walked out of the boardroom with the same posture I'd walked in with. Nobody stopped me. Nobody said my name in the hallway. And that was when it landed, not as anger, not yet, but as clarity. For 22 years, I had been the person who made sure the systems didn't fail. The one who kept the infrastructure standing while the executive team told a growth story to bankers and analysts. And in the exact quarter that story was about to become a valuation, they had decided my work was the thing to trim so the numbers would look cleaner on a prospectus. I joined the company at 27. Back then, it was a mid-sized software firm with 3 unstable data centers and a client list that stayed loyal mostly because switching vendors would have been more painful than tolerating our outages. I came in as a systems engineer, not a title anyone brags about at reunions, but I understood something most of my peers didn't. I could see failure before it happened, not through intuition, through pattern. The way a certain workload behaved on a Thursday afternoon told me exactly what would break by Sunday night. For the first few years, that was all I did. Prevent things from breaking. Nobody notices that kind of work at first. When something doesn't fail, there's nothing to point at. There's no incident report, no war room, no email from the CEO thanking the team for a heroic recovery. Just a quiet week. And quiet weeks don't get bonuses. But over time, people started to depend on it. Managers started routing decisions through me before they were made. Engineers stopped asking whether something could be done and started asking me if it should be. There was a stretch in year 6, I remember it clearly, when a Fortune 500 client was 3 weeks away from ending a 9-figure contract. Their transactions were timing out during peak hours, and no one on our side could isolate the cause. I spent 41 hours in the office over 4 days, tracing it back through 6 layers of middleware to a memory leak that had been introduced during a routine patch 2 months earlier. I wrote the fix, tested it, deployed it. The client stayed, the contract renewed, and the only acknowledgement I got was a 2-line email from a director who left the company the following year. That became the shape of my career. Fix it, document it, move on. Over 2 decades, I built the infrastructure that made the growth story possible, the platform migration in year 9, the multi-region redundancy build in year 12, the compliance framework in year 15 that let us close enterprise deals the sales team had been chasing for years. Every one of those projects had a name on the press release. My name was rarely one of them. That didn't bother me at the time. I told myself the work was the reward, and the compensation was steady. Not extraordinary, but steady. Raises came a little smaller than they should have, promotions came a little slower than they should have, but I had a house that was 3 years from paid off, a daughter starting her 2nd year of law school, a wife who had built her own career as a hospital administrator and understood what long hours looked like. We weren't wealthy, we were secure. And in a world that felt increasingly unstable, security had a value I wasn't willing to trade. But there was something underneath all of that, something I never said out loud. A significant portion of what kept the company running lived in my head, not because I hoarded it, because the systems had grown faster than the documentation could keep up. There were architectural decisions from a decade ago that only made sense if you had been in the room when they were made. There were dependencies between services that weren't captured in any diagram. There were workarounds that had become permanent because replacing them would have taken a year of engineering time nobody wanted to fund. I was the map, not the only person capable of reading the terrain, but the one who had walked every path. And when a company is preparing to go public, when the S1 is being drafted, and every operational risk gets a paragraph in the prospectus, the person who holds the map matters more than the boardroom seemed to understand. Or maybe they understood it perfectly. Maybe that was the point. Michael Hartwell joined on a Wednesday. By the following Monday, he had a corner office on the executive floor, an assistant reassigned from the CEO's own team, and a seat at every meeting that mattered. He came from a consulting background, one of the big 3 firms, and he spoke the language investors wanted to hear. Runway, multiples, operating leverage, category leadership. His slides looked like they had been designed by a marketing agency, because they probably had been. He was introduced as our Chief Strategy Officer, a role that hadn't existed the week before. The internal announcement described him as the executive who would guide the company through the IPO transition and position us for public market success. Nothing in the announcement mentioned infrastructure, engineering, or operations. Nothing mentioned the people who had built the actual business he was going to sell. The first sign that something was shifting came in his 2nd week. We were in a preparation session for the roadshow, going through the risk factors that would need to be disclosed to potential investors. I was walking through the operational dependencies, the specific points where our platform could be vulnerable under the kind of transaction volume a post-IPO growth story would demand. I was maybe 3 minutes into the presentation when Michael raised his hand. "Daniel, I appreciate the depth here," he said, his voice smooth, almost apologetic. "But I think we need to reframe how we're presenting this. Investors don't want to hear about vulnerabilities. They want to hear about resilience." He turned to the rest of the room. "What Daniel is describing is actually a competitive moat. Our infrastructure sophistication is a barrier to entry. Let's tell that story." The room nodded. The CFO wrote something down. The CEO smiled. And just like that, a technical risk assessment became a marketing bullet point. I didn't correct him. There was no point. The correction would have been received as defensiveness. That's how these dynamics work. Once someone with the right vocabulary reframes your work, the reframe becomes the version that gets remembered. Over the following weeks, The pattern repeated itself with a consistency I started to find almost admirable. Every technical concern I raised got translated into a strategic positioning. Every operational limitation became a strength being underappreciated. Every warning about scaling risk became evidence of how conservative our current growth projections were, which of course meant we could raise them. Michael was not building strategy. He was building narrative. And narrative was what the bankers wanted. There was a moment about a month into his tenure that stayed with me. We were in a pre-IPO working session with the underwriters. Deutsche Bank on one side, Morgan Stanley on the other, 12 people around a table trying to align on the financial story. I had been asked to present the technical due diligence findings. I walked through the material carefully, honestly, flagging the capital expenditure that would be required in the first 18 months post-IPO to sustain the growth trajectory the company was projecting. Michael let me finish. Then he stood up, walked to the front of the room and said, "I want to build on what Daniel presented. What he's really describing is our investment thesis. The infrastructure spend isn't a cost, it's the flywheel." He spoke for 11 minutes. He used the word flywheel 4 times. When he sat down, one of the bankers said, "That's a much cleaner story." That was the phrase, a much cleaner story, not more accurate, cleaner. And in the machinery of an IPO, cleaner beats accurate every time. I understood then that my role in the pre-IPO process wasn't going to be advisory. It was going to be raw material. The substance behind Michael's presentations, unattributed. The person who built the reality that his slides would describe. And the bonus structure that had just excluded me was not an oversight. It was a signal. The alert came in at 11:52 on a Tuesday night. Same platform, same channel, same tone I had been responding to for years. A latency spike in the payment processing layer, the kind of thing that starts as a rounding error and turns into a full outage if you don't catch it in the first 40 minutes. My laptop was already open on the kitchen table. My wife had gone to bed an hour earlier. The house had that specific quiet it gets after 11, the refrigerator humming, the ice maker cycling, nothing else. I looked at the alert. I looked at the folded packet from the boardroom, which was still sitting on the counter where I had dropped it 3 days earlier. That dash was still there, still visible from across the room, and it hadn't gotten any smaller. For 22 years, my response to a midnight alert had been automatic. Open the terminal, pull the logs, trace the anomaly. Fix it before the on-call engineer even finished their first cup of coffee. Half the incidents I resolved never made it into a formal report because they were resolved before anyone else noticed they had started. That night, I sat there and did something I had never done in 22 years. I followed the process exactly as it was written. I logged the alert in the incident management system. I flagged it to the on-call engineer with a note describing the symptoms. I attached the relevant dashboards, and then I closed the laptop. No workaround, no shortcut, no stepping outside the scope of my job to keep the machinery quiet for another night. I want to be clear about something. This was not sabotage. Nothing I did would cause damage. The on-call engineer was competent. The runbook existed. The system was designed to handle this exact scenario without my direct intervention. I was simply choosing, for the first time in 2 decades, to trust the process the company had documented rather than the invisible layer of judgment I had been providing for free. If they wanted a lean pre-IPO operation, they could have one, exactly as it was written down. By 7 the next morning, the on-call engineer had resolved the incident. It had taken him 4 hours instead of 40 minutes. The payment layer had been degraded during that window, meaning some transactions had queued rather than processed in real time. Nothing catastrophic, nothing that would show up in a headline, but there was now a 4-hour degradation on the operational record that would need to be explained if anyone asked. At 9 that morning, the messages started. First from the on-call engineer, thanking me for the detailed handoff. Then from his manager, asking if I had time for a quick call to walk through the root cause. Then from the VP of engineering, asking why I hadn't jumped in directly. I responded to each of them with the same tone, professional, precise, within the boundaries of my role. I documented the issue and escalated per protocol. The on-call team handled it appropriately, happy to discuss the underlying architecture in our next scheduled review. That last line was the part that mattered. Our next scheduled review. Not tonight, not right now, not on a Sunday, on our next scheduled review. I had never used that phrase in 22 years. At 10:14, a message from Michael appeared in my inbox. The subject line read, "Quick sync." The body was 2 sentences. "Daniel, I heard about last night. Want to make sure we're aligned on how we're presenting operational reliability in the roadshow deck. Coffee at 11. I read it twice. The message was not about the incident. The message was about the story. He wasn't worried about the platform. He was worried about the narrative. And that, more than anything else, confirmed what the dash on my packet had already told me. I met Michael at the coffee bar on the ground floor of the building at exactly 11. He was already there, 2 cups on the table, both black, because he had never asked how I took mine. That detail sounds small. It wasn't. In 4 months of working in the same building, on the same executive committee, preparing for the same IPO, he had not learned one thing about the person whose infrastructure his entire strategy relied on. "Daniel, thanks for coming down," he said, sliding 1 cup toward me. "I wanted to catch up before this afternoon's roadshow prep." He smiled the way people smile when they've rehearsed the opening of a conversation. "Last night's incident, I heard the response time was a little longer than usual. I want to make sure we have a clean story if any of the analysts ask about operational uptime during the roadshow." I let him finish. Then I said, "The incident was resolved within the documented SLA. The on-call team followed protocol. There's no gap in the story." He nodded slowly, as if he was considering whether to push. Right. I just want to make sure that as we present our infrastructure as a competitive moat, the operational data supports the narrative. We're going to be showing analysts our incident response metrics, and I want the trend line to look strong going into the filing." There it was. He wasn't concerned about whether the platform was reliable. He was concerned about whether the numbers on a slide would support the story he had already written. I took a sip of the coffee, which was too hot and too bitter, and I set it back down. "Michael, the trend line will reflect what the trend actually is," I said. "If you want the metrics to look a certain way in front of analysts, the way to do that is to invest in the infrastructure and the team, not to manage how incidents get reported." He didn't blink, but something in his expression tightened just slightly at the corners of his eyes. "I hear you, I do. But we're in a sensitive window right now, Daniel. The board is watching every operational disclosure. This isn't the moment for anything that could be interpreted as a red flag by our underwriters." "Then don't create red flags," I said. "The team executed the protocol as designed. The response time was within the SLA. That's the story. It's already clean." He tried a different angle. He leaned forward, softened his voice, added a little warmth to it. "Look, I know things have been a little bumpy on the compensation side. I want you to know I've been advocating for you at the board level. Post-IPO, there's going to be a lot of room to revisit the executive compensation structure. I'd hate for anything in this window to complicate that conversation." That was the moment I understood exactly what kind of man Michael Hartwell was. Not incompetent, not even cynical, really. He was transactional in a way that had been polished into something that looked like leadership. And the offer he had just made, an implicit promise of future compensation in exchange for present cooperation on how the incident got characterized, was the cleanest version of a soft threat I had received in 22 years. I finished my coffee. I stood up. "I appreciate you making time, Michael. The incident report will reflect what actually happened. That's what the auditors will see, that's what the underwriters will see, and that's what I'll sign my name to." I walked out of the coffee bar and back to my office. My phone was already buzzing before I reached the elevator. A message from a number I hadn't seen in almost 3 years. Rachel Menendez, former colleague. Now the COO of a private infrastructure firm that had been acquiring senior talent aggressively for 18 months. The message from Rachel was short. "Daniel, I heard your head's down on the S1. When you come up for air, I'd love 20 minutes. No pressure, no pitch, just a conversation." I read it in the elevator on the way back up to the 23rd floor. By the time the doors opened, I had already decided to reply, not because I was ready to leave. Because for the first time in 22 years, the idea of a conversation with someone outside the building didn't feel like a distraction. It felt like oxygen. I typed back a single line. "Thursday evening works. Anywhere quiet?" She replied within a minute with the name of a restaurant I had never heard of, a small place about 20 minutes from my house. 7 o'clock. No further explanation. That was another thing I noticed. When people know what they're offering, they don't need to explain themselves in advance. The rest of that week moved strangely. The roadshow prep intensified. Michael scheduled 2 full-day sessions with the underwriters, 3 separate rehearsals of the CEO's opening pitch, a mock Q&A session with a former SEC attorney playing the role of a skeptical analyst. I was in every one of those sessions because the technical questions required a technical answer, and Michael needed me in the room even if he didn't want me on the slides. I answered every question honestly. I gave the underwriters the same numbers I gave the internal team. I did not soften anything. When one of the Morgan Stanley bankers asked about the capital expenditure trajectory for the first 18 months post-IPO, I gave him the actual figure, not the version Michael had been floating in his slides. The banker wrote it down, underlined it twice, and asked no follow-up. Michael watched me across the table with an expression I couldn't quite read, somewhere between recalculation and warning. On Wednesday, the CFO stopped by my office. She didn't sit down. She stood in the doorway with her hands in the pockets of her blazer, and she asked me, in the casual tone people use when they're trying to sound like they're not conducting an interview, whether I was feeling supported through the process. I told her I was executing my responsibilities as defined. She nodded. She asked whether there was anything on my mind I wanted to share directly with her before the filing was submitted. I told her I had already documented everything the auditors would need. She nodded again. She left without saying goodbye. That night I sat in my kitchen and thought about what she had really been asking. She wasn't checking on my morale. She was checking on my compliance. She wanted to know whether I was going to be a problem during the quiet period, whether I was going to raise something with the auditors that wasn't already in the disclosure, whether the dash on my packet had been read by me as a signal to align or as a signal to leave. I don't think she knew yet, which meant I still had time to decide what kind of signal I was going to send back. Thursday evening, I drove to the restaurant Rachel had suggested. It was tucked between a florist and a shoe repair shop in a strip that looked like it had been forgotten by the last 3 waves of gentrification. Inside, the lighting was low, the tables were far apart, and the menu was 2 pages long. Rachel was already there in a booth at the back, no laptop, no folder, just a glass of water and a small notebook. She stood up when she saw me and shook my hand with the kind of grip that told you she meant it. "Daniel, thank you for coming. I know this week has to be brutal." I sat down, and the conversation that followed changed everything. Rachel didn't open with a pitch. She opened with a question. "Before I say anything about why I reached out, I want to know how you're actually doing, not the LinkedIn version, the real one." I looked at her for a moment. 22 years of executive dinners, of client conversations, of board updates, and I couldn't remember the last time someone had asked me that in a professional context and meant it. I told her the truth. Not the whole truth, but enough of it. That the IPO prep had exposed something about how I was being valued, that I was reassessing. She listened without interrupting. When I finished, she took a sip of her water and said, "Okay, now I'll tell you why I asked." She explained that her firm, a private infrastructure company backed by 2 major growth equity funds, was building out its executive team for a scaling phase. They had just closed a Series D. They were not preparing for an IPO. They were preparing for durability. And they had a specific problem she thought I could solve. Their platform had grown faster than their infrastructure could support. They had made acquisitions in 3 verticals. They had inherited 4 different technology stacks. They needed someone who could walk into that complexity, hold the whole map in their head, and rebuild the foundation without breaking the business that was running on top of it. She described the problem in detail for about 10 minutes. She used the words that people use when they actually understand the work. Not flywheel, not moat, not category leadership. Words like dependency, latency, technical debt, integration surface. When she finished, she said, "I'm not going to give you a number tonight. I want you to sleep on the problem first, but I want to be clear about what the role would be. You would report to me and to the CEO. You would have full authority over infrastructure, platform, and operations. You would have a seat on the executive committee with real voting weight, not the observer role a lot of companies pretend to offer. And the compensation would reflect the scope." I nodded. I asked her a few questions about the CEO's operating style, about the board's expectations, about how decisions actually got made when priorities conflicted. She answered each question directly. No hedging. No corporate language. When I asked about the exit horizon, she said, "We're not building for an exit. We're building for a business. If a good exit shows up in 5 or 7 years, we'll consider it. If it doesn't, we'll keep compounding." That answer, more than anything else she said, made me listen differently. I had spent the last 4 months in rooms where every conversation was oriented around a single event on a single date. The IPO was the sun that every other decision orbited. And here was someone telling me that her company was oriented around the work itself, and that any exit that came would be a consequence of the work, not the reason for it. We talked for another hour. I asked about the team I would inherit. I asked about the compensation philosophy for the layer below me. I asked about how she handled disagreement with the CEO. Every answer she gave sounded like it had been thought about, not rehearsed. When the check came, she paid it before I could reach for it. "Don't decide anything tonight," she said. "I'll send you the formal offer on Monday. Look at it, take it to your wife, take a week. And if you want to walk away, walk away. This isn't a trap." I drove home slowly. The radio was off. My wife was already asleep when I got in. I sat in the kitchen with a glass of water and looked at the folded packet from the boardroom, still on the counter, still showing that dash. And I realized something I hadn't let myself realize before. The realization was simple. The dash was not the end of a negotiation. It was the beginning of a repositioning. The board had not forgotten to include me. They had actively decided that my compensation, in the specific quarter when the IPO financials would be locked into the S1, was the line item they could remove without the underwriters noticing. Because on paper, my role was infrastructure. And infrastructure, in the language of an S1, is a cost center. Removing a bonus from a cost center improves the operating margin. Improving the operating margin lifts the valuation. And the difference between a good IPO and a great IPO can be 100 basis points of margin at the moment of the pricing call. They had traded my bonus for a rounding error in the valuation. That was the calculation. Not personal, not vindictive. Just cold enough to be almost admirable if it hadn't been done to me. And once I understood that, I understood something else. The people who make that kind of trade once make it again. Whatever they promised me for the post-IPO window, whatever equity acceleration or retention grant they floated as a soft signal, would be subject to the same calculus the next time an investor conversation required a cleaner number. There was no version of the future in which staying was the winning move. Rachel's offer arrived on Monday morning at 8:04. I read it once in my office with the door closed. The base salary was significantly more than what I was earning. The equity grant vested over 4 years with a 1-year cliff and had a valuation attached that, if the company hit its plan, would make the equity component alone worth more than the total compensation I had accumulated across 2 decades at my current firm. The signing bonus was structured to make me whole on any bonus I would forfeit by leaving before my current firm's fiscal year closed, which, of course, they knew was zero. Rachel had built the offer as if she assumed I was being treated fairly, which was itself a form of respect. I closed the offer. I opened my calendar. I found a 30-minute slot on Tuesday morning that was still free. I booked it as a personal meeting and gave it no title. Then I called my wife. She listened for 4 minutes without interrupting. When I finished, she said one sentence. "Daniel, you've been carrying that building on your back for 22 years. It's time to put it down." I sat in my chair for a moment after we hung up. Then I opened a blank document and started drafting the resignation letter. I did not write it out of anger. I wrote it the way I had written every technical document in my career. Precise, complete, non-inflammatory, 2 paragraphs. First paragraph, notice of resignation with a specific end date 30 days out. Second paragraph, offer to support a structured knowledge transfer during the notice period, subject to reasonable working hours and a defined scope. No mention of the bonus, no mention of Michael, no mention of the S1, no hooks for a counteroffer, no emotional openings that could be reframed as a negotiation, just a clean, professional exit. I saved the draft. I did not send it yet. I wanted to think one more time about the sequence. If I sent it before the S1 was filed, the underwriters would see a senior infrastructure departure disclosed in the risk factors. That would be uncomfortable for the company but not fatal. If I sent it after the S1 was filed, it would be disclosed in a subsequent amendment, which was worse because it would look like something the company had tried to hide. Either way, the timing was going to matter to somebody upstairs, but it was not going to matter to me. I had already been priced as a rounding error. There was nothing left to protect. I sent the resignation letter at 7:58 on Tuesday morning, 6 minutes before the executive committee's daily stand-up. The timing was deliberate, not to embarrass anyone but to make sure the letter was in the CFO's inbox before she walked into a room where my absence would need to be explained. I copied HR. I copied the general counsel. I did not copy Michael. That was also deliberate. If he wanted to know, he could read it in the room like everyone else. By 8:47, my calendar had been overwritten by 3 emergency meetings. The first was with the CEO and the CFO in the CEO's office, doors closed. I walked in at 9. The CEO was already seated behind his desk. The CFO was in one of the 2 guest chairs. She did not stand up when I entered. Neither did he. He gestured to the empty chair. I sat down. "Daniel," the CEO said, folding his hands on the desk in front of him. "This is an unexpected letter. We're 4 weeks from filing." I nodded. "I understand the timing is inconvenient. That's why I structured the notice to cover the filing window and offered a knowledge transfer plan." He studied me for a moment. "Is there something we can address? A specific concern that led to this?" I chose my words carefully. "I've reviewed my compensation and my role in the pre-IPO structure. The decision reflects my assessment of both." That was all I said. I did not mention the dash. I did not mention Michael. I did not give them a specific grievance they could isolate and negotiate against. Because the moment you name one thing, the conversation becomes about that thing and the larger picture disappears. The CFO leaned forward. "Daniel, I want to be direct. If this is about the last bonus cycle, that was a technical decision tied to the filing window. Your compensation was scheduled to be restored and enhanced after the pricing call. We were planning to sit down with you next week to walk through the post-IPO structure." I looked at her for a long moment. She was probably telling the truth. That was the part that made it worse. She was telling me that the plan had always been to trade my present for my future without ever asking me whether I consented to the trade. "I appreciate that," I said. "The decision is made." The CEO tried a different angle. "What if we brought that conversation forward today, right now? We can have HR draft a retention package by end of day, equity acceleration, bonus restoration, title adjustment, whatever it takes." I let him finish. Then I said, "I've accepted another position. The start date is 31 days from now. I'm here to make the transition as clean as possible during my notice period. That's what I can offer." The room went quiet. The CEO looked at the CFO. The CFO looked at her notepad. Neither of them asked where I was going. That was interesting. In 22 years, I had watched a dozen senior departures, and the first question had always been where. This time, neither of them wanted to know because the answer would immediately become a data point in the risk assessment for the filing, and they had not yet decided how to handle that data point. I stood up. "I'll send a formal transition plan to the general counsel by end of day. If you want to schedule a follow-up, please route it through HR." I walked out of the office. My hands were steady. My breathing was normal. There was no adrenaline. There was only the clarity of a decision that had been made correctly, executed correctly, and communicated correctly. The letter was in their inbox, the offer was in mine, and the machinery of the IPO, which had been built on the assumption that I would absorb whatever they asked me to absorb, was about to discover that the assumption no longer held. The next 30 days were the strangest of my career. I executed the transition plan exactly as I had promised. I documented every architectural decision, every dependency, every workaround that had lived only in my head. I ran 3 formal knowledge transfer sessions with the engineering leadership team. I answered every question that came through official channels. I did not answer any question that came through back channels, and there were many. Michael sent me 4 separate messages asking for a quick call. I responded to each of them with the same line: "Please root through the transition plan document." He stopped messaging after the 4th. I left the building on a Friday afternoon at 5:11. There was no send-off. A few of the engineers I had worked with for a decade stopped by my office to shake my hand. One of them, a woman I had hired 8 years earlier, hugged me and did not say anything, which was the most honest goodbye I received. I carried a single box out to my car. 22 years, 1 box. That ratio told me everything I needed to know about what the company had actually been for me, and what I had actually been for the company. I started at Rachel's firm the following Monday. The work was harder than anything I had done in the last 5 years, and clearer than anything I had done in the last 15. Every decision had a defined owner. Every priority had a stated trade-off. When I raised a technical concern, it was treated as information, not as an obstacle to a narrative. My first paycheck arrived at the end of the month, and the number on it was not a reward. It was a correct measurement delivered on time with no ambiguity. That, more than the size of it, was what I had been missing for 2 decades. The IPO filed 6 weeks after I left. The S1 was public. I read it once carefully, the way I would read a technical document. The risk factors section included 2 paragraphs about recent senior leadership departures in the infrastructure organization. The language was measured. The underwriters had done their job. The roadshow began 10 days later. I did not follow it closely. I heard fragments through former colleagues. The pricing call was delayed twice. Analysts asked harder questions than expected. 3 institutional investors reduced their allocation the week before pricing. The IPO priced at the bottom of the range. And then, in the days after pricing, the story got worse. A payment processing incident during the first week of public trading created a 4-hour disruption that made it into the trade press. An analyst report published 2 weeks later flagged concerns about infrastructure investment relative to growth projections. The stock closed its first month below the IPO price. By the end of the second quarter, it had lost nearly 40% of its opening valuation. The company was still operating. It was still generating revenue. But the story Michael had built for the roadshow no longer matched the reality the market was measuring. I did not celebrate. I did not send messages to former colleagues. I did not read the coverage with satisfaction, because what happened after I left was not caused by my leaving. It was caused by the same calculus that had put a dash on my packet in the first place. A company that treats its foundation as a rounding error will eventually be measured by the market as exactly that. If you're watching this and something in your own situation sounds familiar, ask yourself one question. Not whether you're valued in words, whether you're valued in numbers on the page, in the quarter that matters. Because words are cheap and numbers are honest. If this story resonated with you, take a moment to like the video, share it with someone who needs to hear it, and subscribe for more stories about the quiet decisions that change everything. Leave a comment and tell me what you would have done in that boardroom.